on that front. And congratulations, Mr. Chandramogan, on a very, very good set of numbers. But I wanted to question you on your debt. That appears it has gone up marginally, holding at around 2,000 crores. I recall when we charted the last time around, you said that you have some capex that's underway, but in the next 2 years, that debt will come down to around 500 crores. Is that on track? And could you tell us, should we be saying that in the second half of FY26, the debt comes down to 500 crores?
No, actually, it is possible because probably we have got a buffer stock to manage the summer. This is the reason why it is just not the machinery alone. So we will be able to moderate it. The inflow is getting better. Stocks will also get reduced. So July of 2026, the debt can be brought to the level what we want. In case if there is going to be a potential expansion, it may differ. Depending on the market sentiment, we may have to do it. If there are no major investments, it is possible to bring it down.
Mr. Chandramogan, value-added products, right, like ice cream, curd, etc., in aggregate, it's about 30% of your business. Could you put out some sort of details for each of these segments specifically? What are you expecting? I mean, will these grow much faster?
The value-added product is a branded product, not just milk, curd, or ice cream. All our products are branded, and our sales is 96 to 97% is branded products. And we have no differentiation. All products are comparatively having a good growth and a better margin. The reason being we are market leaders in every segment where we are present.
You wouldn't differentiate between, okay, it's all branded. And I take that point. I was just sort of making the differentiation between milk, curd and ice creams. And typically we'd kind of sort of call the other two, the latter two, as value added.
Definitely the segments of curd and ice cream is increasing as a percentage of revenue among the basket compared to milk. Definitely it is also contributing. But without milk, nothing can happen.
Obviously,
can you tell me a little bit about the gross margins as well? Your gross margins have now improved to almost 31%, thereabouts. Is there scope to improve it further?
1.5%. Probably that will also reflect in PBDIT and then further down.
Okay, so 1.5% improvement in gross margins is what we can expect. And what's your targeted spend on advertising, if you can tell me? Because, things are picking up, competition has also gone up quite a bit. So in terms of, as a percentage of your sales, how much are you comfortable spending over the next 1 to 2 years?
Approximately 2% we will be spending on the revenue.
Okay. All right, Mr. Chandramogan, also, you could tell us about the targeted contribution from the North-South geographies. In the past, you've mentioned that you would like, Tamil Nadu to decline a little bit. So could you tell us how is the geographic sales breakup panning out and where do you see it headed?
Tamil Nadu today accounts for 52%. By end of the year, that is beginning of the next year, I expect it to be 48% because the growth, most of the growth is happening in the new markets.
Okay, and non-South, how much does it contribute right now?
Sorry?
Non-South.
No, there is no non-South. Non-South is only Maharashtra and also dairy commodities. Mostly we are into South.
So it contributes non-South, if I have to call it that, and as you're saying, it's mostly Maharashtra. Currently, how much does it contribute? 15, 18%?
Probably if you leave non-South, it may be about 9%. Because mostly it is ice cream and not dairy products. Except
okay, 9% of the total revenue mix, and you would like that number to move up as well, I think, to around 20% in the next few years, right?
That's right. We have only 2 factories in Maharashtra. The rest of the factories are all here in South. 18 factories are here in South. Only 2 factories we have in Maharashtra.
Okay, all right, Mr. Chandramogan, we'll leave it at that. Thanks a lot for joining in and appreciate your time here. Let's take a quick break on that note. On the other side, Santanu Chakrabarti, the India analyst BFSI at BNP Paribas, will join in to discuss trends in the banking, financial services and insurance space. Stay tuned.
Okay, welcome back. 60 points is where you have the Nifty trading up by 22,396. Lots happening in the broader market with individual names seeing large moves. I just want to pull up GSPL, which had sold off aggressively yesterday. It is seeing a big reversal today. GSPL was not in the mix in the morning when we looked at these stocks. It's up 7% after yesterday's very sharp fall. Of course, the fall for GSPL happened from 380 kind of levels all the way down yesterday to about $300, but it's clawing back to about 325 right now or so. We just spoke with the management of Hatsun. Of course, it was up 10% when we started the interview. It's added another 3% since then, so about 13% higher on Hatsun, 1160 right now. And Honasa is the other one, 6.5% move, 430 on Honasa is what you have. Now, let's just focus on the BFSI space, the banking space really. BNP Paribas has said that opportunities are hiding in plain sight. HDFC Bank is their top pick with an outperform rating, and they got a price target of 2,410 rupees in the stock. Let's discuss about this name and the broader space as well. Santanu Chakrabarti is India analyst, BFSI with BNP Paribas. Santanu, great to have you with us here. Before we get into some of the nitty-gritties of what you have put out in your report, at a slightly higher level, have you adjusted your forecast of the net interest margins for your coverage universe a little higher in light of the fact that compared to where we were at the beginning of this year in January, I think the market's kind of adjusted to the fact that, we will not see deep rate cuts or anything, if at all, So does that give a bit of a lift to NIMs across the universe, across your coverage universe? Santanu, go on.
Thank you for the opportunity. So, we have to keep in mind that delayed rate cuts are a double-edged sword for them. And you're absolutely right that your FY25 NIMs will look better if you get the cut in October instead of August. But that would take a little sheen of what FY26 looks like. You see, the interesting thing about net interest margins is that it actually bottoms out probably a quarter after the rate cuts happen, because of a simple reason that nowadays so much of our lending is repo rate linked, right? Whether it's some of the prime corporate loans, whether it's the mortgages, and therefore some of that prices down absolutely almost immediately, right? So please keep in mind it's a double-edged sword. I mean, of course, rate cuts happen. Hopefully, CASA picks up from there. There's greater momentum in high yield loans. All of those are good things, but just keep it in perspective that rate cuts are not a bringer of immediate joy.
Hi, Shantanu. Good morning and good to see you. What about this toss-up between the private versus public sector banks? You had the private banks that underperformed, but maybe part of that good news with regard to the PSU banks is in the price, and maybe those ratios don't look as good from here on, from the second half of this year. That's FY25. How do you see things panning out?
I think the 1 year forward earnings prism, for better or for worse, has been the driving factor for the banking industry as a whole in their stock prices. If you look at did we have a bad FY24, for example? No. On earnings growth, we had a pretty good FY24. Did we have a equally good FY24 on stock prices? We didn't. And the reason to me is very simple, that the eye was very much on what FY25 growth looks like. So my key thesis is, the flip side of this should play out in FY25, where FY25 in itself may not look great on earnings growth, purely from the margin moderation which is happening. You're not talking about anything else on asset quality or anything else, or growth slowing down, purely margins. Then FY26, as margins moderate back upwards from the cyclical lows, is when you're going to again get a little bit of an earnings spike and probably a re-rating through the financial year. That's been our thesis. Now, as far as the PSU versus private thing is concerned, look, I mean, we just finished an extensive set of meetings both in India and outside, and the appetite and interest in PSU names is really stunning, and it is in some sense an exact inversion of probably what would have happened 5 years back, where almost any questions that you might raise at any point about any PSU or their history or maybe longer term persisting structural problems are either brushed aside as things that are getting incrementally fixed in India at a fast rate, or essentially that why are you worried about it now? Why don't we worry about it when the time comes 2 to 3 years from now? And the exact opposite stands true for names like Bajaj Finance or HDFC Bank, where everything is kind of viewed through this prism of radical skepticism, right? That, is the NIM 3.65? Is it 3.7? Can it mobilize 1.66 lakh crores again? Okay, it may not be able to do it in Q1. But what is the fine number? Is it 1 lakh crore? Is it 1.5 lakh crore? Questions going way beyond this, right? And that was a
Sure.
that's why I'm saying that the opportunities are hiding in plain sight, because you're using two very differential standards on asking questions and valuations for the two subsections of the BFSI space.
Got it. You have tracked the NBFC space for very long as well, Santanu. I wanted your thoughts on what's happening with M&M Finance, right? I mean, they've deferred the board meeting. There is a fraud at one of their branches. From an investor standpoint, a long-term investor standpoint, how do you approach it? Because M&M Finance has been extremely volatile in the past, reacting very severely to any kind of news flow. But your thoughts here?
I don't want to comment on the stock price, etc., because it wouldn't be appropriate given that I don't cover it. But I think broadly, any event that comes out in a financial services business, which raises question marks about processes, etc., will be generally taken fairly seriously by the market, and the burden of proof generally shifts to the company, and that's a challenge we have seen in many cases. I mean, milder cases. Also, we have seen, even in where companies have remedied these things well, stock prices take some time to come back. And, essentially the burden of proof will always lie with the company.
In NBFCs, Santanu, what are your top ideas?
So Bajaj Finance is our top outperform. And again, I mean, here, when I went and spoke to clients, so many of the investors tell me that, look, Shantanu, there's no way this company can continue to grow high, not because of, something on demand or something on competition or something like that, just because RBI won't allow it to. And I found that a fascinating pushback, quite simply because, here's a company that's growing at 34, putting out a presentation where one whole slide in bold letters is, we're going to grow at 25 to 27% for the next 5 years. Now, nobody is, privy to the conversation that RBI would have with any other company. But does it make sense to you that, given that conversation, any company in the world go out and tempt their fate with regards to the regulator? It doesn't make any sense to me. And so that's where the opportunities are, because if the pushback was on, do you think, Shantanu, that this many customers can be added? Or, is the upsell possible? Or what role will competition play? Now, those are legitimate questions, and of course, people will have different opinions about those things. But some of the stuff is really edge case out there, things that I have heard about large caps in this particular phase of the market.
That's interesting stuff, really. Santanu, did you, in clients, did your financial services come up?
We don't yet, again, have coverage on the name. I mean, it's still an early stage company. But of course, when clients speak about, competition in a generic sense, they're thinking of every single entrant into the Indian financial markets. And I think that can play a suitable role. Is evaluated, if not in terms of what the business is today, but in terms of what it brings to the table, whether that in some cases may be capital, in another cases may be specific kinds of data that others do not have, and so on and so forth. Or it may be just capital wherewithal. All those parts come up, but not in a recommendatory sense, of course.
Okay. What about Axis Bank coming out with numbers tomorrow? Any thoughts there?
Actually, we are expecting a small disappointment in Axis Bank. Not very large one. Mainly because I think the markets probably building in the consensus seems to be building in slightly higher net interest margins than what we expect, which is a function of essentially how much of, say, their organic CASA plus Citi acquired CASA they're able to hold on for the quarter. My numbers are a little different. Having said that, Axis Bank is my third preferred pick within Indian banking. That because of one very simple reason. It is the highest liability beta name out there. It's 16% short-term borrowings. And short-term borrowings, once rates get cut, will get completely repriced in 2 to 3 month period. So let's say if it's a 150 basis point drop on the overall yield curve, that goes straight to 16% of your funds in a 3 month period. That's a significant number. And it's much faster repricing than what you'll see in most other names.
All right, we'll let you go on that note. Santanu, thanks a lot. Appreciate your time here on CNBC TV18. So that's the word coming in from the banking and the BFSI segment analyst. By the way, markets are still quiet. The Bank Nifty is actually almost in the red. So, there is a little bit of trepidation that you are seeing at the moment. And a couple of these names, L&T, Axis Bank, Britannia, Hindalco are all down almost about 1% odd. So some bit of trepidation in the market. It's time for our special segment, Quarter Se Quarter Tak. We bring you earnings expectations from each sector. Today, we'll tell you what the cement sector could look like in this quarter. Nigel, over to you.
Well, for the past quarter, cement demand remained strong, but prices declined. But the lower prices, well, they were partly offset by input cost tailwind. Let's take this piece by piece then. On the demand front, January was weak due to weather and pollution-related restrictions, but there was a growth pickup in February, and March was the strongest month. Volume growth is likely to rebound in Q4 on account of heavy discounting push by companies and also a pickup in year-end construction activity. The street is expecting the industry demand at around 8 to around 9% in Q4, which is a big improvement on a sequential basis. For the year, well, the derived volume growth for the industry is likely to be around 9% odd. On a regional basis, South was underperforming, while West as well as Central India, well, they were the best performing regions. Cement prices declined continuously for around 5 months after the price hikes that were taken last in September to October 2023. Realizations in Q4 FY24, well, they're expected to plunge by close to around 5% on a sequential basis, despite being a seasonally strong quarter. Prices were impacted by what? By intense price competition among the larger companies as they were trying to gain market share. The highest decline in prices on a quarter-to-quarter basis was seen in East India, which was at around 8% odd, which was followed by other regions, which is in the vicinity of around 3 to around 5% on a sequential basis. But spot international coal and petcoke prices in March, well, they reverted to December 2023 levels. But they're still 5 to around 14% lower in comparison to the averages that we saw in Q3 as well as in Q2. The operating leverage on a quarter-to-quarter basis and flat to declining variable costs, that's what's going to keep the overall cost for the universe under check, declining by around 4 to around 6% on a Y-on-Y basis, and sequentially as well. Well, Jefferies expects stocks under their coverage to see EBITDA per ton dip of around 110 rupees per ton, that's on a sequential basis, but it will grow by around 125 rupees per ton on a year-on-year basis. The EBITDA per ton for most companies will show a growth, with ACC best placed due to the easing cost, volume growth from the recent capacity additions, and also benign valuations in comparison to its peers. Part of growth on a year-on-year basis is because this EBITDA per ton is coming on a very, very low base. Well, Jefferies has put their expectations of the potential out and underperformers for this past quarter. Among the larger peers, well, they expect the highest year-on-year growth for Ambuja at the consolidated level, while Ultratech and Shree Cement are expected to grow by around 18 to 27% in terms of EBITDA growth. Among the mid-cap names, well, Dalmia could potentially underperform with a sub 10% growth, while JK Cement as well as Birla Corp, well, they could outperform with near 50% EBITDA growth. Well, let's wind this down with a quick valuation check, and the snapshot comes up for you on the screen with the valuations as they stand as of now. Well, given that we're in the midst of a general election activity, we could see some slowdown in terms of demand, but the key to track from here on will be price increases that are pushed through, how much of that is absorbed, and also the demand recovery that the street is expecting in the second half of this fiscal.
All right, Nigel, thanks a lot for that. Naveen Sahadev, the analyst at ICICI Securities, is joining in now to tell us what to expect. Naveen, Nigel put it very well on what you can expect from the sector this time around. But your thoughts, which are the companies that you think could sort of outperform this time? And in general, what are the growth trends looking like?
So, of course, Nigel did put it very aptly. But from a growth perspective, I think largely concur that in the large cap space, it's Ambuja Consol, which we think is much better placed. There's a low base effect also to that. And in the mid cap space, then we look at JK Cement, which is very comfortably placed in terms of industry superior volume growth and hence the overall EBITDA performance.
Okay, hi Naveen, good morning and good to see you win. Naveen, we have Kesoram Industries, and that's a very small player, and the real play is going to come once it gets folded into Ultratech Cement. But the last quarter's numbers, if you look at it on a sequential basis, just doing some basic math, the derived EBITDA per ton, it declined by close to 200 rupees on a sequential basis. It could be company-specific issue as well that did play out there. But what is your read-through for the industry? What kind of a decline are you seeing on a quarter-to-quarter basis on EBITDA per ton?
Yeah, so first and foremost, we should all take this into cognizance that quarter-on-quarter decline in a March type of a quarter is rare. So indeed, we are looking at a very unusual kind of a busy season for this. And our estimate is that EBITDA per ton broadly for the coverage universe should decline by about 14 to 15%, which is anywhere between 100 to 130 rupees per ton quarter-on-quarter decline is expected.
Interesting. Naveen, what about the cement story now? As you and most analysts as well are expecting, Q4 will be par for the course. We're already anticipating a decline in the EBITDA per ton. For the first quarter, elections will slow down activity. For the second quarter, you have monsoons that will play out. So now I think we are looking at the second half of the year. For the year though, given that the second half should be much stronger than the first half of the year, what kind of demand growth are you factoring in? Because we did very well in the first half of last fiscal.
Correct. So typically post-election, our latest precedent is that FY19, your industry grew 13%, but in FY20, it was flat, even excluding the impact of COVID right in the month of March. So definitely not expecting that bad a scenario. And there is no that high a base as well. So against a 9% or a 8 to 9% kind of a growth for FY24, FY25, my estimate is more like a 6% kind of a growth. And of course, as you rightly put, it would be mainly from Q2 to the balance Q4, as in for the balance of the 9 months, excluding Q1, which is impacted by volumes or elections.
Okay, all right. Naveen, also there has been this debate about this price increases. You have been tracking it for a little longer than me as well. But we see in April, you have a price increase that's pushed through somewhere in the, towards 10th of April, towards the 20th of April, some kind of price increase. But the better sense you get is, as you approach 20th, how much of it is absorbed? How do you read this? How much of a price increase was attempted to be pushed through? Some reports were suggesting 70 rupees, 80 rupees odd, which is unlikely to take place, right? Because demand is yet to pick up substantially. You have elections as well that are on the offing. So your analysis, how much of a price increase actually got absorbed in April so far?
Yeah, so there is definitely, so far there is a disappointment on the, first of all, the quantum of the price hike itself, and second, also on the absorption of it into the market. And as you rightly put, because typically first 10 days of April have enough and more inventory in the system because of some volume push that happens towards the end of March. So to expect a sharp price hike in first fortnight of April is a challenge. But on the other side, I would put that the quantum has also a bit disappointed to me. They've been talking about some 30, 40 rupees, but in effect, what we're hearing is just about anywhere between 5 to 15 rupees kind of a increase. And broadly, 5 to 10 only has got absorbed so far is what our understanding, which is a little underwhelming.
Okay, all right. Final question then, Naveen, before we let you go. Tomorrow we have Dalmia Bharat that comes out with the set of numbers. And some of these companies, in the run-up to their numbers, they've already seen weakness. If I'm not mistaken, I think Dalmia Bharat is down 15% year to date as it is. And today as well, the stock is under some pressure. It has some south play, some east play as well. And Kesoram's numbers were fairly disappointing. How much of the bad news is already in the price? And what are your top picks from the sector?
So I think the entire cement pack is off peak. Most of these stocks, I would say, are down anywhere between 10 to 15%, some of them even more. So no single stock is trading at a peak, market cap, so to say. And that's largely got to do with the disappointment on the pricing front, and which has been there throughout. Right from November, there has been a very sustained decline. So price hikes happening anytime, I think till month of May are extremely critical to give a support to the FY25 earnings, so to say, and hence they are to be keenly watched. And my top pick in that sense would still be an Ambuja Cement, because that's where I think there is enough and more ammunition for cost efficiency to come through, both capex and non-capex led. And also the recent promoter fund infusion that has happened, they are sitting on a big cash. So we would expect industry superior capacity growth also from them. So top pick is Ambuja Cement.
But between the two, some are finding more comfort with ACC because of the valuations. Though we know in the past, Ambuja has always given superior numbers. And as you're saying, volume growth will be superior as well with the cash balance that they have.
I completely agree. Valuation is comforting in case of ACC, but I would still go with playing the ACC story through Ambuja Cement, because I would like to believe that bulk of the expansion is will come through in Ambuja, and the fund infusion also has happened in Ambuja and not ACC. So Ambuja is my pick in that sense.
Okay, and what about the South companies? Some of them have been beaten down quite a bit. Companies like Sagar Cement, India Cement as well. And when they come to a particular level, then we start putting that valuation argument, the replacement cost, the EV per ton. And if you get some price increases that come about, and some of them, at times, they rebound very sharply. From the South Pack, what do you like?
So we have, from the South Pack, we cover India Cement and Ramco, of course, and we have a positive view on Ramco, largely owing to the fact that it will have an industry superior volume growth, and of course, the largest beneficiary of any price recovery that may happen in the South and Eastern region. India Cements is largely more of a M&A play. So we have it's completely hypothetical to say if the deal happens or not. So we'll largely, we have a sell rating on the stock, and we'll maintain that.
Okay, let's see when that M&A does take place. Naveen, for the last few years, plenty of rumors in the market that something's coming about. It hasn't yet, but for the time being, we'll take all your points with regard to the cement industry on board. Thanks a lot for joining in and giving us your view. So the past quarter could be a little bit subdued. As Naveen said, they are factoring 100-150 rupee decline in the EBITDA per ton, which will be par for the course. But their top pick will be Ambuja Cements because of the cash infusion. There could be some capacity expansion, and they believe that's the better way to play it from both the Ambuja and ACC twins. For the time being, we slip into a short break with news that the Nifty is holding strong with a 70-point gain. But on the other side, we'll turn our attention to the commodity markets. Manisha Gupta will be joining in.
Welcome back. Well, for now, the market is holding. It's up almost about 65 odd points. The Bank Nifty is up about 114 odd points. Mitesh Thakkar is joining in. By the way, just wanted to mention a couple of stocks. There are plenty of stocks that are hitting fresh 52-week highs this morning. And, some of them include names like Indus Towers, which is at a fresh 52-week high. Bharti Airtel, we've spoken about that ad nauseum. Max Financial is at a fresh 52-week high as well. Voltas, people trying to beat the heat. So Voltas is at a fresh 52-week high. Soba from the real estate space, and something like an Avenue Supermarts is also at a fresh 52-week high. But let's go across to Manisha Gupta now. She'll tell us about the commodity space and what she's watching over there. Manisha, over to you.
Thank you for that, Sonia. Well, I'm looking at profit taking across sectors when it comes to commodities. And, well, yes, why not? Because we've seen most of these commodities go dangerously overbought. And now there is some healthy profit taking coming in. I want to take a look at the precious metal prices, where we have seen gold and silver both decline quite strongly in the overnight markets there. If you look at the gold prices, we saw a decline of 2.5%, and the silver prices fell 5% as well. So this is the biggest one-day drop that we've seen in 3 years, especially in case of gold. So it has retreated from its all-time highs. In sense of numbers, when you look at it, the silver prices did touch a 3-year highs at around $28.9 an ounce. It's come down to $26.9 an ounce in the international markets there. And a sharp fall is what we are looking at in the Indian markets as well. For the gold prices, it has been more than $100 of a decline. So from a high of $24.20, we are trading below $2300 right now. So a sharp cut coming in there as well. Well, some of the reasons that you've seen this profit taking coming is one, investors are taking profits, and the portfolio managers also repositioning themselves with the kind of value increase in their portfolios because of gold is what they saw. The second point really is about the dollar index and the US yields, which have jumped quite strongly at 106. It's a 5-month highs for the dollar index, with expectations that you could be looking at higher highs because the US data has been on the stronger side. And then it has been about the US Fed officials also suggesting that the restrictive policies could be prolonged and the first rate could actually come in by the month of September. The street is also looking at the Middle East tensions, which have kind of de-escalated. We've seen Israel restrain response to what Iran did, and the kind of conversations and statements that came in from Israel and Iran also have taken some geopolitical premium off the prices there. Well, there are concerns over vital Middle East conflict even now, and is the reason you could see some support coming in at these levels. But the markets also have reacted to the 2 CME margin hikes that we saw in case of gold and silver, and then trading curve that Shanghai also put across after that one-way rally that we saw in case of gold and silver. But interestingly, there is a report from Citi which suggests that a minor pullback in gold and silver is what you can see by the time second quarter ends. But for the second half of this year, they still have a directional highs expecting in case of gold at around $2,500 an ounce. And for silver, they're anticipating $30 to $32 an ounce on the higher side. So the direction hasn't changed. This is just a profit taking.
All right, thanks a lot for that. Well, let's do one thing. Let's go across to Mitesh Thakkar. He's joining us now. Mitesh, before anything, I wanted your thoughts on Tejas Networks. Huge move over there, 20% rally. Do you think the street can build on to those gains? And what are the other stocks that you're looking at?
Yes, Sonia, I think what a breakout, and that happened with the gap. And I think we discussed that, I discussed that with Prashant earlier in the day also. I think I'm looking at a target in excess of 1150 over here. 1150 toward 1200, I think is the near-term target. But I wouldn't be surprised to see eventually the stock continuing its rally. This looks like a very strong momentum breakouts. If somebody's accumulated in the last few weeks and is holding, I think just hold on. 1250 should be, 1200 to about 1250 should be the logical target, but there's a good chance of us seeing an extension. And therefore, we can even talk about 1350, 1400 zone. So very, very positive for me on Tejas Networks.
Okay, all right. Hi, Mitesh. What about other individual stocks that you're tracking for a 10 a.m. call?
Yes, Najal, I have a buy on Grasim now. The stock, is just trading around the pivot levels of 2315. We had a high of 2312 today, and it's 2308 now. So buy about 2315, 2320 range. Keep a stop below 2295, and look for a target of around 2380 to begin with. And the other one is HL Tech, reversing from extremely oversold levels. Buy here with a stop below 14 and 1469, and a target of 1525 can be looked.
Thanks a lot for that, Mitesh. Well, Mitesh gave us the technical check on Tejas Networks, but Rima joins in for a quick fundamental analysis on those numbers. Rima, beautiful looking screen.
Oh, absolutely. Now, Tejas Networks is a company which makes telecom equipment. So it caters to wireless and wireline network equipment products. And this company has reported some very strong numbers. So in a span of 2 days, the stock is up close to about 40%. Even yesterday, it had a surge of close to about 17 to 18%. Now, revenues for the company have crossed the 1,000 rupee mark, 1,300 crore. It's up close to about 350% on a year-on-year basis. And even on a quarter-on-quarter basis, revenues are up 137%. The company's reported profits after 5 consecutive quarters of losses. EBITDA crosses 300, while the profit is now at 150 crore. And we haven't seen such numbers from the company in a while now. The order book continues to remain strong at more than 8,000 crore as of the last quarter. The cash on the books is about 641 crore rupees. So all that is also adding to the optimism.
Okay, what about Vodafone Idea and Indus Towers, Rima? The moves there are also pretty good.
Yeah, so remember Vodafone Idea, despite all that news about fundraising, there was skepticism. So since the FPO news was announced, we didn't see the stock rally. In fact, year to date, Vodafone Idea is down 15%. Bharti and Indus Towers rallied because they believed that if Vodafone Idea survives, they gave it a probability, then it will benefit the other players. So Vodafone Idea has been a big underperformer on a year-to-date basis, and maybe now that the FPO is successful, we could see that reverse. Now, about the FPO, very strong subscription. There was skepticism whether the retail participants would participate in the FPO, but even retail got subscribed fully. The HNI portion was about 4.5 times, QIB 19 times, and if you remember, even the anchor book at more than 5,400 crore rupees had some marquee investors like UBS, Fidelity and GQG. So this massive 18,000 crore FPO got its subscription of close to about 7 times on the whole. A successful FPO is positive for Vodafone Idea, very, very important, because one, it paves the way for the bank lending, raising money of 25,000 crore rupees from the bank. 2, it provides the company growth capital to invest in 4G and 5G, which improves its market competitiveness, which can help the company bring down its arrest its subscriber share losses. On Indus Towers, and Indus Towers is a stock which has rallied 80% in this year itself. CLSA further upgrades it to a buy from an overweight. They raise the target price to 450. They say that even though the stock is up 150% in the last 12 months, it's trading at a 60% discount to peers. So valuations are not expensive in a relative context, relative global context. And at their fair value of 450, the stock is still at a 45% discount to global peers. And of course, an improved financial position of Vodafone Idea will benefit Indus Towers the most. Back to you.
Okay, all right, Rima, thanks a lot for that. Just take a look at that stock flying away. Telecom, clearly the sector of the day. Vodafone Idea going to the market asking for 18,000 crores, or even X of the anchor book. It got subscribed close to around 7 times. So massive subscription out there. The street believes that there are going to be 3 players from here on. Indus Towers was piggybacking on Vodafone Idea. And if it survives, then it's good times for Indus Towers as well. So clearly big moves out there. A quick check on a few stocks in the broader markets. So just pull up Genus Power. That stock has moved to the high point of the day. HPL Electric as well. That's the other name in there that's moved quite well. It spiked up in the last few minutes. Now it's locked actually with a gain of close to around 10%. So quite a few of these names are building on. Some of them have done well in the last few days, and they continue to build on as well. Markets holding steady with an 80-point gain. For the time being, we'll slip into a short break. On the other side, we'll be joined by Mr. Radhakrishnan, the whole-time director and CEO of Kesoram Industries. We'll discuss the past quarter's numbers and what's the way ahead for the company as well. You stay tuned.
Welcome back. Well, we're just looking at some brokerage calls on Reliance Industries post the numbers. First, let's get the stock up on the screen. Most brokerages actually have a bullish view on Reliance Industries after the numbers were above street estimates. Jefferies has raised their target price on the stock to 3,380. Bernstein has a target of 3,160. Morgan Stanley has an overweight with a call at 3,046, while Elara Capital has actually raised their target price to 3,479 and they have upgraded to an accumulate. Now, the reasons for the bullish views largely because of Jio. Jio's performance was quite strong. It was ahead of estimates on the higher average revenue per users because of an improved subscriber mix. The oil-to-chemicals business was also very strong this time around. Profitability rose because of the robust refining business. The Jio net subscriber additions was also quite robust, almost at 11 million. And retail, although it was a bit muted because of competition, the margin improvement is something that continues. The other big positive for Reliance Industries is the net debt has fallen by 8% year on year, coming in at $14 billion. And now that the peak capex for the company is over, according to analysts, going forward as well, they can, reduce their debt further. So lots of positives in the numbers, and hence a lot of brokerages have raised their earnings estimates and target price on the stock. But standard disclaimer, Reliance Industries is the owner of the channel that you're watching.
All right, Sonia, thanks a lot for that. Well, let's focus on a few stocks that are moving around. Alchem has moved to the low point of the day, so that intraday chart should come up for you on the screen. SAIL as well, had a bit of a breather yesterday, but the stock has resumed its up move. Now it's up close to around 2.5%. It did see some profit taking, but now it's moving up as well. From the metals pack itself, Indian Metal and Ferro Alloys, that stock as well has seen a 10% correction from the recent peak. It had given a dividend of close to around 15 rupees, but in the last few minutes, that one as well is moving up. And Sterling and Wilson is now locked in upper circuit. It's up close to around 10% or thereabouts. Well, as promised, let's get chatting with the management of Kesoram Industries. The past quarter numbers were a little bit disappointing. The good news is the rayon and chemicals business, it turned a bit positive after many, many quarters. To understand what went on, Mr. Radhakrishnan, the whole-time director and CEO of the company, joins us on the show. Hi, Mr. Radhakrishnan. Good morning and good to see you, Win. Well, let's run through a couple of factors. First, on the cement part of the business. What's the timeline for this deal that you have done with UltraTech Cement? By when will the cement part move to UltraTech?
So there are a couple of more approvals required. The CCA approval is in place, right? Now, few more approvals are there. The expected time, we should wait for anywhere between September to March, it may happen.
Okay, second half of the year is when you see this take place. Great. You don't give the volume numbers, but I think, back of an envelope calculation is suggesting that for the past quarter, you did around little more than 2 million tons approximately. And for the year, you did around 7.5 million tons. I recall at the start of the year, you were talking about 8 million tons. Then you scaled that down to around 7.6. It appears you're a little shy of that. Is that correct?
Yes, absolutely right.
Okay. And the EBITDA per ton, for the past quarter, that's actually seen a sharp correction. Because at the end of last quarter, you were at more than 600 rupees. Then you were telling us maybe for the year, you'll do something around 600 rupees odd on an average. But you've ended the year with a EBITDA per ton of around 400 rupees. Is that correct? Because pricing was weak. I think that played spoilsport.
About 500 plus, I would say. Maybe your calculation, other income you are deducting.
No, 500 for the year, right? 500 for the year.
Yeah,
and for the past quarter, it was around 400.
Yeah, correct. For the past quarter, it is 449, right? Q4 was a very bad quarter from a realization front, so far as we are concerned. The markets we operate had a tough demand situation and liquidity to turn tight in the markets. That's where it was.
Okay. So, since you're talking about the price correction, tell us what was the price correction in quarter 4 in comparison to quarter 3? On an average, we just had a discussion and we are working with around 5% sequential dip. What was the dip that you witnessed? And also in April, there were attempts to push through a price increase in markets like yours, South and West. Tell us what is the quantum that you all pushed, quantum that was absorbed as well?
So, between Q3 and Q4 sequentially, on an average, 10 rupees to 12 rupees is the drop per bag. And as March set in the month of March alone, if you look at Q3 exit and March month, it is about 18 to 20 rupees per bag. The prices fall at started falling steeply in the month of March. Now, yes, there have been attempts to increase the price. So far, in some pockets, 5 to 10 rupees has been absorbed. That's where it is.
Okay. All right. So small price absorption is what we have seen. What about the debt? You know, Mr. Radhakrishnan, for last many quarters, I was asking you, Mr. Radhakrishnan, when does the refinancing take place? When does it take place? Finally, it took place, I think, somewhere towards the end of February or March, which will be good news once, this asset goes to the new owner. But tell us, what will be the total quantum of saving on this kind of, because of this refinance that's taken? And more importantly, once a cement asset moves out of the books, in Kesoram Industries, what will the debt be? What will be left behind?
So 220 crores will be the interest saving, 220 crores plus will be the interest saving per annum on the refinancing. The debt which will be left in Kesoram will be zero post the cement asset and the debt moves out of the Kesoram balance sheet. I'm saying Kesoram standalone. Signet, yes, the subsidiary, when it gets consolidated, there will be a 220 crore of debt. That's where we are.
So we look at it on a consolidated basis, sir, because the big asset is moving out. On a consolidated basis, the remaining business basically will have 220 crores of debt. And for the debt that you have, it will be around 220 crores of savings as well, interest cost savings. We got that. Now we have to focus on this pending business that you have, the rayons and the chemicals business. Good to see a bit of a turnaround. Give us a few details. In the past, you indicated there has to be some fund infusion. Then this asset can do, say, EBITDA of around 60 to 70 crores. When is that fund infusion coming? Point number one. Point number two, give us a guidance for this year. What kind of an EBITDA number we should work with for the rayons and chemicals business?
So the EBITDA number for this year is a variable of the time at which the fund is getting infused. So no sooner the fund gets infused, this business will clock in EBITDA of 60 crore per annum. So pro rata we have to calculate from the time of fund infusion. The question is when the fund will get infused. We are working very closely on that. Somewhere before December, the fund should get infused.
And how much of the fund will get infused?
So what it takes, the way to look at it is we want to run it debt free.
Okay, so around 200 crores. So around 200 crores will have to be the infusion then.
So 200 crores and whatever is required to scale up the business, which is under evaluation, will also get infused.
And who will put this money? The promoter entity will put the money. Will you get a strategic investor? Will there be someone else who's interested in putting money? Because otherwise, this business, Mr. Radhakrishnan, it's been struggling for many quarters. And the street has only been interested because of the cement asset. Now they'll want to know what is left. So give us a couple of details then. Promoter puts in money, strategic investor comes in. Who is it?
So ideally, it could be a combination of both. It is too premature to say that. Right, we will keep you updated on that. We are working on all fronts.
Good speaking to you, Mr. Radhakrishnan. We have some idea about how you see things pan out, with regard to the remaining part of the business. And thanks so much for giving us some inputs on the business that moves out, which is the cement business. But we can take some derivation with regard to what's going to happen, particularly in the South and the West market. Thanks a lot for joining in. Well, on that note, though, we'll wrap up on this edition of Bazaar. Chartbusters comes up next. You don't want to miss it. Welcome back. Well, just keep an eye out on the India VIX. There is a big drop that we have seen. I've not seen this sort of a drop actually. The last time we saw this sort of a drop was way back in 2014 as well as 2016. The VIX, it gives you a rough indication with regard to volatility that's expected. So two factors, either the markets are revving up for a big rally or we're getting a little too complacent. And that's why that's down closer on 19% as we speak. So that's a big drop out there. I don't know whether we have some candles, we'll be able to tell you the kind of drop that we saw the minute the markets opened itself. So that's a big drop. It's trading at multi-month lows out there. So that's the India VIX as well. Well, in the next few minutes, we'll get you a couple of managements. One is with regard to persistent systems. And later on in the show, we'll get you the management of Rajratan Buyers. Mangalam joins us as well on Chartbusters. Hey, Mangalam.
Hi, Nigel. Let's talk about persistent systems itself. It was the stock on the way down in yesterday's trading session, and that's largely because despite good numbers, the management commentary with regards to margins wasn't pretty good. In fact,